As you can see, this company has been paying dividend consistently. In today's video, we're gonna be looking at 3 stocks in Nairobi Securities Exchange that might be undervalued. And we're gonna start with going through the value investing metrics that will help us understand whether these stocks are undervalued or not. Thereafter, we're gonna look at the fundamentals that will help us analyze whether these companies are worth investing in. And finally, we're gonna go through the reason why these stocks might return 20 to 40% if the market corrects. So without further ado, we're gonna start with some of the key metrics that will help us in analyzing whether these stocks are undervalued or not. And one of the key metrics that you can look at is the low price to earning. So a low price to earning relative to peer or industry average suggests that the stock may be undervalued. And from the list that I'm going to share with you, these are stocks of companies in the banking sector. And currently the average price to earning ratio for banks in Africa is between 6.4 to 6.5. And in the Kenya market, it is around 4.6. Another key metric that will help you in analyzing whether a stock is undervalued is a low price to book ratio. So a price to book ratio of 1.5 or lower indicates the market price is lower versus the company's book value. And in Kenya market, the average price to book ratio for the banking sector is around 1.1. Another key metric to look at is strong fundamental. So a company should have good profitability, earning stability, and healthy cash flow. In addition to that, we have dividend support. So if the company pays a solid dividend, it provides a margin of safety for value investor. So that company should be paying dividend. Finally, another key metric that you should look at is the future growth and business strength. Even if undervalued, the company should have reasonable growth prospect or a strong business model. And let's now go into our 3 stocks that might be undervalued in the Nairobi Securities Exchange. And one of the stock is of a company in the banking sector, and that is KCB Group. The current share price of KCB Group is 59.50, and recently the share price of this company had shot up to 62 Kenya shillings. So this might be the best time to invest in this stock. But before we go into the metrics that will help us understand whether this company is undervalued, you can see that this company has been paying dividend. And one of the latest dividend that they will be paying is 4 shillings. And the current dividend yield is 5.74%. And let's see some of the key metrics that will help us understand whether KCB share is undervalued. And one of the key things is price to earning, which is currently sitting at 3.45. And the average in the Kenya market, especially in the banking sector, is 4.6. So you can see that KCB has a lower price to earning. And also when it comes to price to book ratio, it is sitting at 0.54, which is below 1.1. As we saw earlier that the average market price to book ratio is around 1.1. And let's now look at some of the fundamentals, which is also key when it comes to understanding whether a stock is undervalued or not. So for the first quarter, they reported a good operating income, but they also had some pressure, especially in non-performing loans, which had a percentage of 17.8%. And for the 9 months to September 2025, KCB Group reported a strong performance with net profit of 47.3 billion. And the return on equity reported for this company is 21.6%, which means that this KCB Group company is utilizing shareholders' money well. And this is one of the reasons why you can bet on this company. One is strong regional presence and also digital strategy, which could drive future growth. As I told you earlier, you should also look at the future growth of these companies if you are looking for undervalued stock. And also, they have dividend potential or capital appreciation is attractive for patient investors. And one of the risks that you should monitor when it comes to investing in KCB Group is the non-performing loans, which is relatively high. So you should monitor that if you want to invest in KCB Group. And let's now go into our second undervalued stock, which is also in the banking sector. and that is Equity Group Holding share. The current share price is sitting at 63 Kenya shillings, and the share price of Equity has been on the rise for the last few months. And as you can see, this company is also paying dividend, and one of the latest dividend payment is 4 shillings 25 cents, and the dividend yield is sitting at 6.72. And let's now go into some of the key metrics that will help us understand whether this company is undervalued or not. As you can see, price to earning ratio for Equity is currently at 4.6, and that is based on Q3 results. And this is almost the same as the average of the banking sector in Kenya, but below the African banking sector average. And when you come to price to book ratio, it is below 1.1. The current price to book ratio for Equity is 0.78. And let's see some of the fundamentals. For 2025, profit after tax grew by 32% to 54.1 billion, up from 40.9 billion in Q3 2024. So that is a comparison of the third quarters of 2025 and 2024. And in terms of return on equity, the current return on equity for Equity Group is 24.5%, which is higher than that of KCB. So this company is also utilizing shareholders' money well. And let's now go into some of the reason why you can bet on this company. As you can see, this company has a lower price to book ratio, and they also have a solid regional franchise, which gives it the potential for growth. In addition to that, they are likely to provide a mix of dividend plus upside, making it a good long-term value play. And one of the risks that is involved in investing in Equity Group share is macro risk in regional economies, credit risk, and potential competition. So those are some of the risks that you should be aware of when it comes to investing in Equity Group shares. And let's now go into our third stock that might be also undervalued in Nairobi Securities Exchange, and that is of a company in the banking sector too, and that is Co-operative Bank share. The current share price of this company is 23 shillings, and this is one of the most affordable shares in Nairobi Securities Exchange. And as you can see, this company has been paying dividend consistently, and currently they paid a dividend of 1 shillings, that is the interim, and for the last 3 years they have been paying a dividend of 1 shillings 50 cents. And let's now see some of the key metrics that will help us understand whether this company's stock is also undervalued. And as you can see, the price to earning is sitting at 3.6, which is below 4.6, that is the market average for the banking sector in Kenya. And also the price to book ratio is sitting at 0.65, which is below 1.1. And the return on equity is sitting at 19.4 based on Q3 results of 2025. And let's look at some of the fundamentals. That is, the profit after tax for 2025 increased by 12.3% to 21.6 billion from 19.2 billion of Q3 2024. And they also declare a dividend of 1.5 Kenya shillings for shareholders. So the net profit for this company grew by 12.3% for Q3 2025. And let's see some of the reason why you can bet on this company. So this company has a good profitability and consistent earning in growth. It also has a high return on equity, suggesting efficient use of equity. The dividend provides an income cushion, and finally, strategic digital transformation under its soaring eagle agenda will also boost the growth of this company. And one of the risks that you should watch out for when it comes to investing in Co-operative Bank is credit risk from loans default, macroeconomic exposure, and digital transformation execution risk. So those are some of the risks that you should watch out when it comes to investing in Co-operative Bank stock. And let's now go into some of the entry strategies that you can use in order to maximize your returns with these 3 stocks. And one is to buy on dip. Look for a period when earnings dip or the market is pessimistic and use them to accumulate. So when the market is pessimistic about a stock, the share price of that stock will drop. So that is the best time to buy this stock. Another entry strategy is to accumulate over 6 to 12 months. So don't try to time the perfect bottom. Spread your buying over time to reduce risk. And this is called dollar cost averaging, which is an investment strategy where an investor places a fixed amount of money into a particular investment. For this, it is in the stock market at a regular interval, regardless of the share price. So that is the best way to invest in the stock market. And also, another entry strategy and investment strategy that you should have in order to gain more from these shares is to hold for 3 to 5 years, because value play may take time to re-rate, so be patient for the market to recognize their true value. So you should hold this stock for long term. Finally, watch for revaluation catalysts. Earning peaks, reduction in credit risk, and improved dividend payout could trigger re-rating. So if any of these companies announce additional dividend, then the share price will also rise, because people will be yearning for those huge amount of dividend. And let's now go into some of the risks that you should also be aware of when it comes to investing in this stock, before we go into some of the reason why these stocks might return up to 20% if you invest in them. And one is value trap. Sometimes cheap stocks are cheap for a reason, so you should always understand the reason behind that stock being cheap or the share price of that stock dropping. So always check the fundamental. Another risk is macroeconomic risk. Banks are sensitive to interest rate changes, credit cycle, and economic downturn. So the interest rate by the CPK will always affect the banking sector profit. So you should also check out or watch out for that. Another one is competition and digital disruption. For banks, traditional lending must coexist with digital banking. Poor execution can hurt. So you should also watch out the execution process for digital transformation, like for example in the equity and also the cooperative bank. And the final risk that you should also be aware of is liquidity risk. Ensure these stocks are sufficiently liquid for your buy and exit strategy. For these three stocks, I think these are some of the most liquid stocks in Nairobi Securities Exchange. And finally, let's go into some of the reason why these hidden gems could return 20 to 40% when the market corrects. And one is, if the market re-rates, this based on justified earning growth and book value, they are very low price to earning and price to book multiples could expand. So if the market is able to re-rate and incorporate this earning growth and also book value, then the share price of this company might go up and you'll be able to have some capital gain. Another one is their fundamental strength in profit and return on equity gives a cushion, not just a speculative bet. So you are not just betting on these companies anyhow. As you saw, the return on equity of this company is 19% and above. For example, cooperative is 19 point something, for equity it's 24, and for KCP Bank, it's around 21%, and they also pay dividend payout. So these are companies that offer income while you wait for the stock of these companies to rise. And finally, regional expansion, especially for equity, which is expanding across the East African region, and also transformation in the digital banking space done by KCB Group and also the Cooperative Bank could unlock additional value for this stock. And those are some of the reasons why you can bet on these companies. So if you are to invest in these companies, always do your due diligence and consult more with your financial advisor. So take this video as an educational video that will help you in identifying undervalued stock in Nairobi Securities Exchange and also how to invest in Nairobi Securities Exchange.